you speak a little bit about bonds and kind of your thoughts on where we are in bonds with the crazy interest rate environment, even before, some of the more recent stuff. But the question was, I don't only want to get into total cash, but shouldn't I would it be a wise idea to move some of my stocks to bonds to theoretically take quote unquote less risk?
Again, there's that risk word again. It is very much a question of what does your plan call for? So we don't view the stock market as some big casino where, hey, let's roll the dice and let's place a bet on red 24 because I think that's really going to be the thing this year. We look at what the client's hoping to achieve, and we do that in a very written way, so we know what those goals are, and we have an adult conversation about it. And then we look at what the portfolio design would need to be over the long haul to achieve those goals. For us and for the types of clients we have, they have these long-range goals, such as, I'm going to retire at this age, and I'm probably going to have a 30 or 40-year retirement. That's an incredibly long time. We know that inflation is the biggest risk that person faces. It's not volatility day to day, month to month. It's inflation. Inflation will eat you alive in retirement. It's not discussed all that much, particularly since inflation's been, historically speaking, rather tame here for the last decade. But if anyone's been around since the 1980s, inflation actually can be a really bad thing. It can really destroy asset values over time. And so if we know that someone's got that long of a horizon, we would document that there's probably a very appropriate place for stocks to play a strong role in that portfolio. We may have some bonds in the mix to help support that, but we would not look at, gee, this just happened in the market. Shouldn't we go over here to avoid risk? I will tell you that bonds are a ticking time bomb right now. And I'm not trying to make that much a market call, but when rates go down as low as they have, they generally speaking only have one direction to go, and that's up. And there's an inverse relationship between interest rates and bond prices. And I'll make it as simple as this. If you go out today and try to buy a 10-year treasury from the US government, it is absolutely safe. You will get your money back, and you'll get whatever interest rate is associated with that bond. I don't know what the 10-year treasury is at right now. I mean, it had gone down to some ridiculous number recently. It might be hovering around 1 right now. Let's just say that it's 2. It's not that high. Let's just say it's 2. So you could buy a 10-year treasury right now, and you can put $1,000 in. You'll absolutely guarantee get your $1,000 back in 10 years, and you'll get your 2% interest. But if inflation is at 3%, the only thing that we've done here is we've guaranteed that you're going to lose money over time. You're going to lose purchasing power by investing in this. To me, that looks really risky. Why would I sign up to intentionally lose value? So the inflation thing cannot be ignored. Plus, you get taxes on top of that. But we'll leave those out of the picture. So, running to the asset class that so far this year has actually generated positive returns in the rearview mirror seems to me to be not a very smart strategy. So we have, just generally speaking, in portfolio design at Oxford, we're not big users of bonds at all. But because we have the stability bucket that provides a lot of support for people's spending needs, and then we're, in our growth bucket, we're pretty heavily invested in stocks at all times. We believe that is the right long-term thing to do to help support our clients' long-term goals. And we document that with the client. We have a good conversation about it, and we all say, yep, let's do this.